Hello, everyone. Welcome and thanks for joining us on this lovely day for this webinar on social finance tools for community housing providers. I'm Dina Grazer. I'm the director of the Canadian Alliance for Transit Connected Housing, otherwise known as CATCH. And I'm joining you today from Toronto, which is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewas, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. This land is also part of the Dish with One Spoon territory, a treaty between the Haudenosaunee Confederacy, the Anishinaabe, and allied nations to peaceably share and care for the land and its waters. We are grateful for the opportunity to work here and accept our responsibility for honoring this treaty in the spirit of peace, friendship, and respect. I am delighted to have an all-star panel with us today for this session, and in a moment I'll turn it over to our moderator. But first, a little bit of housekeeping. This session is being recorded. Please keep your audio off and your video off. It will be made available in a few days on our resource center, and I'll ask our Stephanie or Devin to put the link to the resource center in the chat for y'all. If you want to turn on live captions or translated captions, there's a little button at the bottom that says show captions and an arrow to select your preferred language if you'd like. If you would like to, please tell us who you are and where you're signing in from in the chat. And you can feel free to put questions and comments in the chat as we go along, and we will try and address questions if we can. We also have a little 2-question survey right near the end, and we hope that you will complete it before you go. And now I am delighted to introduce our moderator, Amanda Knight. Amanda is the program manager for Nova Scotia with the Community Housing Transformation Centre, which is one of CATCH's alliance partners. She played a leading role in the development and launch of Nova Scotia's Community Housing Capital Fund in collaboration with government and sector partners. We'll put her full bio in the chat so you can read it. And I'm going to turn it over to her now to introduce our panelists and run the show. Amanda, over to you.
Thank you so much, Dina, and welcome everyone. So today's conversation is about practical capital tools, not theory, not silver bullets, but real financing approaches that are in use or soon will be in use to unlock affordable housing across Canada. We'll explore what these tools are, where they work best, where they don't, and what it realistically takes for community housing providers to access them. You don't need to be a social finance expert to follow or benefit from this discussion. In order to save time, we will also be placing the panelist bios in the chat for reference. And I would like to welcome our panelists. First, we've got Stephanie Pinnington, Director of Growth and Partnerships from Tapestry Community Capital. We have Irene Gannitsos, the Interim Executive Director from Vancity Community Foundation, and Andrea Nemtin, CEO from Social Innovation Canada. In your 5-minute, each of our panelists will have a 5-minute presentation, so they will introduce the organization, the financing tools that they work with, and provide an example that illustrates how these tools work in real life. So I am going to start with Stephanie.
Thanks so much, Amanda. I'll just share my screen. Bear with me for 1 second. All right. Thanks so much for having me today. It's so nice to see so many people on the line. As Amanda mentioned, I'm with an organization called Tapestry Community Capital. We are a nonprofit organization that works nationwide to support other nonprofits, charities, and cooperatives to access investment from their community of supporters. To date, we've helped to raise over $135 million from roughly 4,300 community investors. Everyday Canadians, people like you or I, that invest, as little as $250 in an organization. We actually got our start in the renewable energy sector, raising community investment for community-owned renewable energy projects, first in wind and then solar, bioenergy. And several years ago, we were approached to see if we could use this model to finance the acquisition of a social purpose real estate asset. And that was sort of what pushed us into social purpose purpose real estate more broadly, and eventually into the affordable housing sector, which now makes up about 80% of our work. Tapestry was created in 2018 with the goal to solve this challenge. On the one side, we have nonprofits, charities, and co-ops across this country that are doing incredibly meaningful work, providing essential services. And on the other side, we have Canadians that want to invest their money with purpose. These nonprofits, charities, and co-ops need access to capital to realize their mission. And we have this growing movement of Canadians that want to not just do less harm with their investments, like divesting from oil, from war, from other harmful activities, but want to actually put their capital into investments that are doing more good, generating more good, especially in their own local communities. And so we use a social financing tool called a community bond. Not very complex. It sounds different and complex, but functions very much like a normal bond was. Essentially, it's a tool that allows an organization to take a loan from a community member. So someone like I could purchase, let's say, a $5,000 bond. It will have a fixed term, set interest rate. So, for example, I could buy a $5,000 bond with a 5-year term at 3% interest. I'm going to earn that interest annually. And at the end, when the bond matures, I will receive my principal payment back. That capital goes to the organization. They use it for their social purpose. So in the case of affordable housing, it's often to, let's say, fund pre-development activities or for the acquisition of a building. They have a revenue stream which allows them to make money and to be able to service that debt over time and eventually to be able to repay those investors. And what's interesting about this model is that it can actually create a really sustainable revolving source of capital. So what we've found over time is that 70% of investors will actually choose to reinvest at the point of maturity because they've been happy supporting the organization, they've received their interest payments, and they want to stay engaged. So we help sort of in two main ways. We act as a consultancy, so we support organizations from the very early stage in learning about the model, then getting set up to actually be able to take a product to market, so designing their community bond, and then through to the raise phase where they're actually intaking investment and beyond. So we also provide back office services where we do the bond administration. And then we also provide a proprietary software that we've developed to actually allow those bond purchases, those transactions to take place and to allow that bond administration for the life of those bonds. This is sort of what our process looks like. So every organization begins through a planning and feasibility phase. So we work with organizations to assess first if community bonds, if accessing community investment is the right fit for them. So there's sort of three main components to that first step. The first is to be working together on a financial model to see how much debt they can sustainably service over time and at what terms. So we're looking at their financial situation and seeing what they can afford in terms of the cost of capital over time. Then we're taking those bond terms and supporting organizations to go to their community. So of course, we want to be able to assess, we've designed this bond, is there going to be appetite in the market to meet that investment target? So that community consultation is a really critical piece. And then the final one is sort of that planning step. What is it going to take to see this through to the end? Does an organization have the capacity to be able to do this? If organizations complete that stage and we feel confident and they feel confident that this is a good fit, they move into a structuring phase. So that's where we support to put together all the legal documents. So we put together an offering package, and we support organizations to find a trustee that will represent their bondholders. And we're setting up all that sort of back-end administration to be able to intake investment. Then through the raise phase, it's really the organizations that are going out and doing the sales and marketing activities on their own. So no capital comes through Tapestry. that investment goes directly to the organization, but we are supporting sort of behind the scenes with best practices to be able to reach that investment target. And then, like I mentioned, we provide that back office administration. So that's everything, including like coordinating interest disbursements, tax forms when it's that time of the year, producing reports that are needed for any auditing purposes. Sorry, I'll speed along here because I know I'm taking more than my 5 minutes. This is just sort of a snapshot of the types of organizations we're supporting right now. So not all of these are in the affordable housing sector, but many, many are. And we're supporting a wide range of organizations doing different things. So we are working with some organizations that are funding deeply affordable, supportive housing, through to community land trusts that are looking to preserve affordable housing in perpetuity through the acquisition of existing affordable housing. So there's really a wide range of applications for community investment. And I think we'll get into that a little more in the discussion, so I won't spend any more time there. But I will take a quick minute to drop that we are launching our Community Capital Readiness Program. So this is live right now, and we are taking applications in up until April 3rd. So for anyone that's interested, if you go to our website and click Raise Capital, you can see that opportunity there. I will now hand it over so I don't take any more time.
Thank you so much, Stephanie. That's amazing. Next up, we have Irene, if you'd like to share some information.
Sure. Let me just share my screen. Sorry, I don't know what people are seeing.
We're on slide.
There we go. Okay, got it? Can everybody see this? Can you hear me?
Perfect. Yep, you're good.
Okay, hi everybody. My name is Irene Gannitsos, and I'm just recently the interim executive director at Vancity Community Foundation, but my main job is as director of social finance and overseeing the Vancity Affordable Community Housing Program, which mostly currently operates in BC, but we are doing some activities outside of the province. Just to say, you know, who we are, I'm with the Vancity Community Foundation, which is an affiliate related to the Vancity Credit Union. Vancity is the main investor and founder and partner in the affordable housing program. And then we also work closely with Vancity Community Investment Banks. Some of you in Ontario may be clients or may be familiar with the investment bank. Our program's mission is to preserve and grow the supply of community-owned, climate-ready homes. We do this through 4 ways, and the main one, I always say our bread and butter, is we fund early-stage projects. So both by providing grants to get a project from an idea to a viable business plan. And then we have a loan program that supports groups to get through to construction. I'll talk a little bit more about that. We also seek to build capacity in organizations for development through supporting portfolio reviews or real estate strategies and occasionally working capital for the organization to build its development team. We do some work to try to strengthen and support the sector, whether that's supporting education events, research, advocacy work, and then we pool capital for impact. So we blend philanthropic capital, grant capital, government capital with impact investment capital to deliver the program. I'm going to just get into what we do. So many of you may have heard of our program before, but we have a comprehensive suite of services that really aims to support organizations to unlock land and unlock construction financing. So we really focus on those critical early stages to help an organization either redevelop an existing site, develop underutilized land, respond to an RFP from a municipal government for a development project, or acquire land. So our grants provide, they're small, $25,000, $30,000 for vision, feasibility studies. Even for preparing for a bond campaign, we will support organizations that are looking to develop other financing tools. And then our accelerator loan fund provides low-cost loans that help advance due diligence, municipal approvals, detailed design to get projects to construction. These loans are meant to be low barrier and low cost. They're offered at 3% simple interest. There are no payments required, typically until the first draw of construction financing, or sometimes they can stay in the project until post-occupancy, until the first refinancing of the project. I'm just going to go into the loans. We have a few different kinds of loans. The pre-development loan, 3% simple interest, the pre-construction equity loan, which can stay in the project 5 to 10 years post-occupancy. And then our acquisition loans, these aren't huge loans, we're not doing mortgages, but we have provide some support for equity gaps, deposit requirements, pre-acquisition work that supports an organization to secure financing to acquire a project. I think I mentioned this already, but who we work with, just to give you a sense of some projects, I'd say, maybe 50% or more of the projects that we've worked with are redevelopment of existing housing sites where there's potential for densification, aging buildings, and mostly with existing housing organizations. New development on underutilized land. We work quite heavily with the faith-based sector, who is looking to explore development and redevelopment, including housing on their sites. And then more and more, we're also seeing municipalities and other public agencies bring land to bear and partnering with nonprofit developers. And we support nonprofits, cooperatives, First Nation governments, and Indigenous organizations primarily. And just to give you a sense, like we've done since 2011, 121 loans, 49 million in capital, and 97 unique projects. And we're doing a little data analysis, and we know that about 65% of the projects that we've supported have reached occupancy or construction, and only 10% of the projects are not proceeding. And also half of those did end up repaying their loan, and then the other half we've written off. Just quickly to share, we do have, sorry. Oh, what happened? I just wanted to note that we do have a mixed capital model. Oh, I guess I must have deleted a slide or something. That allows us to raise capital from impact investors. We have $11 million from Vancity and from CMHC in the fund, and we've raised $21 million to date from impact investors. Currently, we have a $25 million loan fund, and we're looking to grow that to be able to expand and serve more communities across Canada. Thank you.
Great. Thank you so much, Irene. And on to yourself, Andrea.
Thanks. Hi, everyone. I'm Andrea. I think I might know a few people on the call. I'll just sort of share my slide as well. Hold on one moment. There we go. How's that? Can everyone see that?
Yep.
Good. So first, it's great to be on the call with Irene and Stephanie. I love Tapestry, and I've always been a fan of Vancity's work in the pre-development. One of the first ones to really sort of plug these gaps. I just want to give a bit of a shout out to them both. I've learned a lot from watching both of those programs develop. The Catch Fund, it's got the same name as Catch, the organization, is investing in affordable transit-oriented housing using a blended capital approach. It's a project that started with, I work at Social Innovation Canada, and we started working on housing back in 2020 when we started to look at the financialization of housing and the impacts. We did a large non-market housing fund prototype that was inspired by the bonds in the US because we really wanted to try and find ways to flow institutional capital into non-market housing. Saw that was a real need. Small funds exist, but we really needed much more capital to be able to reach our needs. We then went very tight onto the very acute issue of transit-oriented affordable housing in Hamilton to try and apply what we'd learned in the previous labs And what's come out of it has been the Canadian Alliance for Transit Connected Housing and the Catch Fund. Sorry, I'm on the wrong screen so like everyone on the call is probably here for the same reason, and that's that our really real need for affordable housing supply, and specifically our impact thesis, is that it needs to be non-market housing to be able to have a sustainable approach to solving the challenge. So we know that even RBC is suggesting almost 500 million new social housing units, and this is just social housing, not even non-market, all of the non-market cooperatives and nonprofit. And this is because this is such a dramatic chart. We've seen the decline of social housing units from 1972. They represented 30% of the units, and percentage of houses built 21%. Down to 2010, it was 1 or 2, and I think after 2010, it even went below. So we're starting to see this ramp up. We're seeing all kinds of new innovative ways to try and get this going again. But this is really, we can see that this has been something that's happening over the last 40 or 50 years. We also know that it's really good to live near transit. So transit-oriented communities are more connected, they're sustainable, and they're prosperous. The challenge is that when the transit is developed, it can have an adverse impact on housing affordability, in part because the property values increase by up to 40% for homes near rapid transit. So what we're seeing is that the pressure from what we need is transit development on the housing crisis actually exacerbates the problem of affordable housing. Non-market housing providers have a harder time getting land. The naturally occurring affordable housing starts to disappear, it gets redeveloped for condos, and the people who need transit the most actually get displaced, which then costs the transit departments more because they need to go further and further afield. This was happening in Hamilton. It's one of the examples of places across the country where this is happening. And it happens differently in different cities. So some cities have a lot of land, others have less land. But in Hamilton, we were seeing the displacement of, when we were doing the lab, 170 people had already been displaced out of very low cost rental housing, and they just had nowhere to go. And so the other thing around these, where this development is happening, is they tend to be very dense in core housing needs. So 15%, actually 30% of the people that lived along the transit line were in core housing needs. So they tend to be areas that have a lot of low cost housing and people in need of it. So the lab brought everyone together. It was really a very bottom-up approach. We worked with the CMHC was in the room the whole time, the innovation department, FCM in Hamilton. We worked closely with the Community Foundation, and then we brought this city, the Hamilton municipality, the housing secretariat, and many of the housing providers into the room to try and develop financing solutions and funding pathways to preserve existing and create new affordable housing near transit corridors. That was the goal of our work. What we found was in Hamilton is home as a group of non-market housing providers. They had actually worked with the city to map 4,000 potential units. This is a third of the affordable housing needs in Hamilton at that time. And those units were actually held by local non-market housing providers, and they were within 800 meters of the LRT lines. But they were facing financing barriers. And so we talked to them and really said, like, what are the barriers? Because everyone says they need money, and we need very specific kinds of money for very specific things, right? And different times along the continuum. Just they had delays and high cost of financing for pre-development, something that the Vancity Fund is addressing. They had delays and high costs of financing for construction. There was no acquisition funds. There was a high cost of borrowing for mortgages and a lack of flexibility for some of the organizations in terms of mortgages. They couldn't get them, sometimes because they had no down payment, other times because their balance sheets wouldn't hold them. And then there was a lack of affordable and flexible financing for retrofits and renovations. And so these are things that were in real projects. We actually modeled out real projects and looked at the performance. So this is what it looked like in terms of along the sort of the product timeline, like the different moments at which the housing providers were saying, we need this here and that there. We designed the fund around that, and we designed it with two different pieces. One was lines of credit for pre-development and construction cash flow. And these are directly to the housing providers because the loan to value ratio was something that we didn't want this loan to prohibit them from getting other financing. And they needed term loans, both for acquisition, land and building, and with permanent financing. Not long-term, like these aren't 20-year mortgage, but they're not designed to replace MLI Select or any of the mortgages that can be gone through what's already existing, but just sort of the little gaps until they had enough equity to get a better price. We looked at other examples. So we looked at the revolving funds across in other jurisdictions for a model to be able to address these needs. And specifically, we found on transit-oriented affordable housing, there was so many examples. And you can see all of these are examples of transit-oriented affordable housing that have quite a similar pattern. There's a 15 to 25% public contribution that allows the funds to then crowd in private capital for the balance. We took this model and started to really flush it out and see how it could work in terms of a blended capital approach. And what we found was that if you have 10% of seed capital, and this is non-repayable, this is different from much of what we're hearing, but this is really crucial because it allows you to be flexible and lose money for impact if you have to. It allows you to protect the investors from the risks that you need to take to be able to achieve the impact with deep affordability. Then you need lower cost investment from public investment. We modeled that at about 10 to 25%, depending on the cost of it. If it's 1%, it's less. If it's 3%, it's more, or 4%, it's more. And then you can actually crowd in 65 to 70% of private capital. Not real estate type investment. This is a really important transition. These need to be considered like loan funds and like bond funds. We're toggling the risk as well as the return. If people are looking for real estate double-digit returns, we're not going to be able to achieve our public goals with those types of returns on these types of funds. But it does. Yeah.
Sorry, I don't want to cut you off here.
Right.
I'm just watching the time.
Okay, thank you for the nudge. We worked with the city, so we do this alongside their granting. And this is sort of what it looks like. And it's a formula that we can scale, replicate, and scale. So now we have Catch. The Alliance is a national initiative led by Dina, established to protect and expand affordable housing near transit. And we have the Catch Fund, which is a new blended capital fund designed to support acquisition, development, and preservation of community housing near transit lines. And that's it. Thank you.
Wonderful. Thank you. Okay, so we have a couple of questions that I'm going to pose to all of the panelists. I'll just jump right in because we are going to watch our time here. So, what challenge in affordable housing financing led to the creation of your model, and what are you trying to do differently? And Stephanie, I'm going to start with you again on this one.
Sure, thanks, Amanda. I think the real challenge that we were trying to address in forming Tapestry and starting to work in the affordable housing sector is the fact that the community housing providers are always at the mercy of other people's decision making. So whether it's going to a bank and having a bank set the terms for the capital that they're borrowing, or whether it be government or waiting for grant funding or financing, we were speaking to organizations that were getting stuck in the financing stage for so long, like upwards of 10 years sometimes. And that's slowing down our ability to like acquire and preserve and build new affordable housing. So I think that's like really the number one thing is giving control to community housing providers to get started, to make the decision that we can do this now. We can set our own financing terms, we can engage our community, and we can start not on others' timelines, but on ours. And I think that's powerful. I also think the ability to engage people that believe in your mission, it's about more than money. It's about growing a community of support and having backing of, potentially hundreds of investors behind you. That's really critical, and that can be catalytic on its own.
Excellent. Thank you. The same question for yourself, Irene.
Great. Am I on mute? No.
Nope.
Yeah, so I like to tell the story, I think, way before the National Housing Strategy in 2011. As you know, Vancity is a credit union and has a lot of members who are housing organizations, community landowners, such as faith-based organizations and other nonprofits. And of course, they were wanting to contribute to the need for housing. And we started both at Vancity and the foundation with, the idea of like, okay, well, if an organization is looking to develop housing and redevelop housing, we can give them a grant to do a feasibility study or a business plan, and then they're going to go to the credit union and get their construction financing. And we found quickly that there's a big gap in the middle where projects are still a little too early, a little too risky, not able to really secure the construction financing that they need to move forward. And that's when the Accelerator Fund, which was formerly called the Pre-Development Fund, was created. And we know that, nonprofits can spend 10 to 15 to 20% in just getting to construction through municipal approvals. And they don't, unlike market developers, they often don't have the reserves and the capital to do that. So that's the main genesis for the creation of the program, is just to speed up project development, catalyze project development. And how we do it differently is we really seek to be low barrier, low cost, and flexible. We don't have firm maturity dates. It's based on the timeline of the project, which is scary sometimes because you never know when you're going to get paid, but it is about recognizing the reality of getting through development and really supporting organizations to take the risk and to engage fully in trying to grow housing for community.
Excellent. So the speed and accessibility. Mm-hmm. And for yourself, Andrea, again, the model and the fund is still in the early stages, but what are you trying to do differently?
Yeah, I think it's similar to Stephanie and Irene. I think we are all come from a principle of ensuring that the housing providers are getting the support that they need to be able to do their work. And so being able to really design with them in the room, listening to exactly what is required. So that's one piece I think that we're all aligned on. I guess the differentiator on ours is twofold. One is that it brings in the municipality, and so it helps us to align the granting, so make it easier and faster for housing providers investment along with granting municipal grants. And so that's one piece. The other piece is that we work with the community foundation. So if we can sort of build a circle of support around the housing providers, and this would include Tapestry as well, so that they can come with their investment. And if we get out to BC, we don't want to replicate anything. So we also want to work with local portfolio managers and other funds. The third piece is that this is a pilot and it's designed to scale. And so and I'm sure I share this with my colleagues. I think we all want to figure out how to create the structure through which large amounts of institutional capital can flow. And so working with the community foundation so that they can invest in this and other investors, that's another key point, so that we can actually try and figure out how to scale this to get national capital, but local autonomous decision-making that centers the affordable housing providers.
Excellent. That's amazing. So Stephanie, what makes a project suitable for community bond financing?
A good question. Mm-hmm. At a high level, there are a few main criteria, I would say. So number one is it has to be a community housing provider, so nonprofit, charity, or cooperative. Mm-hmm. So that's sort of the first qualifying factor. The next would be that an organization is looking to raise at least $1 million. Typically in the affordable housing space, that's like that tends to be the case anyways, although we have organizations approaching us for smaller amounts for retrofits and that sort of thing. So that sort of $1 million mark is where it begins to make sense to use this model. Beneath that, I think it becomes difficult to justify some of the fixed costs, but we are working hard to change that. I guess another one would be ideally you have a community of support to tap into. That's not to say that a newly created entity can't use this model. We have successfully supported, for example, a group in Kamloops, BC, Propolis, brand new cooperative, that they built their community through this tool. But it does help to have a community to tap into. Of course, you need to be able to demonstrate impact and communicate that clearly. And then, like I mentioned, you have to be able to service the debt. So there does have to be a revenue model. And that's sort of a key first question to be answered is this sustainable? Can you carry and service this debt over time? So those would be at a high level, the main criteria.
Okay. And then what stage of the housing project does your approach focus on?
Sure. Well, it can work across, many stages of development, but where we have focused and supported most to date is in financing pre-development and in acquisition. So mostly in areas where CMHC does not have programs, or there's very limited capital or very costly capital. So raising community investment can be very affordable. Like right now we're seeing rates like between 2% and 5%, so very competitive for that pre-development phase. And then just filling that gap in acquisition, like Andrea mentioned, there was a real need. So that's where we've been predominantly working. And more what we've seen is that these organizations that have started raising community investment are now treating it more like a revolving fund. So where it's used for pre-development, they're funding the pre-development of a portfolio project, say 4 projects. When they access CMHC financing or other financing, then they're redeploying that capital into pre-dev for new projects. So it's really being used, even in the case of acquisition, mostly as bridge financing. There's usually another lender that's going to come in, take out the bondholders. But then most of these organizations, because they want to continue to build affordable housing because the need is so great, they're continuing to roll that capital over to scale.
Great. Perfect. Thank you. So Irene, similar, when should a community housing provider approach you to discuss finance options?
It can vary. So if you're really early stage and you have a piece of land, we do tend to mostly focus on organizations that have access to land or own land, and then have some capacity to move forward with the project. You can come to us at the very beginning, and that's where our grant program kicks in. And we think of the grant program kind of developing the pipeline for loans. But if you already have a project that you've developed proposals for CMHC financing, you're already starting to move forward with municipal approvals, and you have a potentially viable capital budget with identified potential sources of financing. We know that things are a bit tricky right now. And, a demonstration that, you have a viable operating plan, you can come to us for a loan. So we call that like you have a completed business plan, but really it's like a viable proposal and you're moving forward into municipal approvals primarily. So that's when the loans would kick in. And sometimes people come to us at that stage and they're like, we're just moving forward to get our development permit. Can we get a grant? And we will typically say no. That's when our loans really serve that purpose, and we preserve the grants for that really, really early stage planning.
Perfect. And I know we had discussed briefly that you've got flexible bridge financing. So how does that change how a project or what's possible for a project?
Well, I think what it does is it just brings in that capital early enough for them to spend the money on municipal approval, all that really costly work. And it it doesn't, require interest payments during that time. So there's no, debt servicing during that time, which I think, facilitates the ability to move the project forward. And then I'd say the third thing is, I think the flexibility in the repayment. Sometimes it's like, should we have a maturity date? And then say, oh, we'd be amending these agreements all the time so just being flexible. And then the other thing we do is, if organizations need more capital, we often, they can come back to us and be like, okay, now we're at this stage and we do need more capital. And often we're more comfortable to do more once they've, gotten further along the pipeline. The other thing that we've seen a lot is, cash flow financing. So there are groups, for example, that got co-op development funding, but they have to do a bunch of work to unlock that. So we will come in and just provide these shorter term loans that enable them to continue the work. We like those because there's confirmed funding at the end compared to some of the other projects. Yeah.
Great. I'm going to jump onto you in 1 second, Andrea. There was a question posted in the chat. It did come up actually, Stephanie, when you were speaking. So do you have a pre-approval pathway for acquisition financing, or do you need the details of the specific deal to model before committing?
Is that a question for me?
It came up while you were speaking, so I'm going to say yes.
Okay. Well, we don't have like a pre-approval process. So I would say that like every organization is coming into this and making their own decisions about moving forward with using the model. So Tapestry, we are not lending the capital. So we are not going through a due diligence process per se as an investor. And we are supporting you to do your own due diligence on your ability to issue a debt product and service debt over time. But that decision making is happening internal to your organization. I'm not sure if that answers the question clearly, but I think that was the question.
Yeah, and I think it does, and if it doesn't, he'll follow back up.
Okay, sure. Feel free to reach out by email. Yeah.
And Andrea, so when major transit investments do come in, housing obviously gets more expensive. And I should say obviously, but not necessarily that obvious. And people do get pushed out. So you did touch on this, but how it really helped to shape the catch model.
Well, I think I think what it does is it makes everything more acute, right? So the need for the non-market housing providers to be able to compete for buildings, for acquisitions, to be able to do that quickly, the need to be able to, so the whole goal around the fund, to be able to align the grants and the investment and to have it sort of move a bit more with slightly less friction. I think there's a theme that's coming through, which is that the non-market housing providers have to really jump through a lot of hoops to get things done, right? Whether it's waiting for the grants or they don't really fit the traditional underwriting. And so what we think of ours as the WD-40 kind of stuff, I think, how can we help get this done? How can we work with whatever else is happening and fill in some gaps so that when there is a moment at which we need to build affordable housing in these communities that are connected so that people can live thriving, prosperous, connected lives, we have the tools to be able to work together to do that. And so the funds actually come out of an engagement process that brings everyone together to be able to do that and envision the kind of communities that people want to contribute to.
And this lines up. Now we are running tight on time, so we've got just about under 10 minutes, but this does line up actually with the next question. I'm going to start with you, Andrea, because you finished off there. So if a community housing provider, municipal leader, social purpose investor is listening and on the call today, and they're intrigued, but they don't know where to start, what is the first realistic step that they should take to approach you specifically with regards to catch?
So I'll just say call Dina. No, just kidding. But actually, so I think that those are three areas that have different needs, right? And so if you're a housing provider, it really depends on where you are. And for us, we're working with the city, so they are your your contact with the city. You apply through the development stream at the Housing Secretariat. I mean, you can get in touch with us as well, but really that's the best stream because we don't want to replicate that process, and folks have so many places to go to already. Um, if you're a municipality, we have a number of different tools on the website, on the Catch website. We've got tools, we've got best practices, we've got research, we've got approaches. And so we want everyone to be able to have access to understanding how they can improve their approach to equitable transit-oriented development. We also provide services to municipalities to help them design that. So building on our experience in Hamilton from a policy perspective. And for investors, and so, we can do that. And third, like the deepest, is we now have experience designing these funds. And so we're happy to help you design that so that we can replicate and scale this with whoever's there, right? We're not going to, we would use whoever's to bring people around. For investors, we also are open to investment, as are all three of us, I'm sure, right? And so if you're in Hamilton and you really want to get your 5% and you want to invest, and give us a call. I'm happy to take your money. Yeah.
Amazing. Thank you. And Stephanie, same question. Where should they start, and what's a realistic first step with your model?
Yeah, that's a great question. So, like I mentioned in my presentation, that first step is really answering that feasibility question. And some organizations, come into this very interested in the model, maybe before even all of their project details have been finalized. And for those organizations, that community capital readiness program is a really good first starting point, to just see if it's a good fit. For others that have a lot of clarity on the gap in their capital stack, they need to act quickly. We also do work with groups on an accelerated timeline. So that's where we would do the feasibility kind of in tandem with structuring the product. But for most organizations that they need to go through this decision-making process with their senior leadership team, their board, going through that feasibility really helps to build confidence in the organization, get buy-in, and be able to move forward.
And that's what I was going to ask. If you're doing the feasibility, there has to be buy-in from the board and an understanding from the board in order to proceed.
Definitely. Yeah, for sure.
Okay.
Yeah, and for an investor, maybe I won't speak from the investor perspective, just in the interest of time, I'll pass it to Irene.
Perfect. And Irene, the same question. What's a first realistic step look like in your model if somebody's intrigued but doesn't know where to start?
Yeah, I think if you're really at the very beginning stages and have land and have opportunity to explore, we always start with a discovery meeting where we try to learn a little bit about what you're doing. Sometimes it's a fit with us, sometimes it's not. So provide some direction. I will always encourage folks to I don't know, maybe I'm too incremental, but not spend too much money right away too fast, and always go figure out, and I'm sure people are sick of me here saying this, but is there a there? So, there are some groups and consultants that do what they call preliminary viability analysis. So really do sort of an order of magnitude analysis to understand, is there a there? And then identify some of your options for moving forward. And that includes understanding what sources of capital you have available and how much non-repayable capital a project might require. So I always think just, start there, start with a little bit of a there, and then work with your board and your consultant to identify the options that you might want to pursue, and think about, community bond offerings, and think about the other sources of capital that you can bring to a project. I think that's all I can say right now. Yeah.
Yeah. And I think when we were talking too the other day, we'd mentioned about how quickly things are changing and being able to pivot.
Yeah. I mean, we always try to have groups look at different scenarios. So for example, some of you may know in BC, there was a funding program from BC Housing called the Community Housing Fund. A lot of organizations would prepare their projects with the idea of applying to CHF, which is provides significant non-repayable capital and operating subsidies. But when we're doing loans for those projects, we would often ask for a backup plan. Like, if you don't secure that funding, what alternative do you have, and how does that affect your level of affordability? And right now, I'm sure everybody's feeling it. There's just a little bit of uncertainty about what are the funding programs for construction and takeout. But hopefully we'll all take some risk and continue to move projects forward to address the crisis. The other thing I would ask, sometimes if there's anyone in the room that's a newer organization and really looking to develop housing for particular populations, is to try to identify partners who might already have land or who are already building, and see if there's a way for you to be a partner in their building, either through leasing some of the units or through taking on some ownership. And that's the other thing that, we try to do sometimes is identify and connect people with other organizations. Not everybody should be building, housing. Yeah.
Absolutely. No, that's great advice. Partnerships are definitely helpful. We do have one final wrap-up question, but I do just want to remind everyone that at the beginning, Dina did mention that we are going to post a short survey. So I will ask our behind-the-scenes crew to post that. Oh, there it is. And if you can fill that in, that would be wonderful. And then it will come off your screen. And then I do have a final question for our panelists. I did have originally in one sentence, but I don't think this group can do it in one sentence. So we'll say in a couple of sentences, what shift, policy, partnership, or mindset do you see would most unlock affordability in Canada, affordable housing in Canada? Who am I going to start with? I'll start with you, Andrea.
Building the infrastructure through which capital can flow to the non-market housing sector, and different kinds of capital, funding below market and at market investment. We can build that. I'm just going to say, what somebody told me once, that when you invest in a mutual fund, 18 people touch your dollar before it gets invested. And so I think we need some infrastructure.
Interesting. Excellent. Thank you. Stephanie.
Well, I would say, like, as a shift, we've already come a long way in using the community bond model, because prior to this, there wasn't really like a mechanism for retail investors to be able to invest in affordable housing projects. So that's already big. But what I'm really excited about and pushing for is, I would love a mechanism, a policy change to really crowd in that retail investment. These investors are taking on a lot of the responsibility of government in creating this critical community infrastructure. And so we would love to see a tax credit program for impact investors in community bonds. And that's something we're really, really pushing for. So Tapestry is supported in creating the Coalition for Community Capital, and we are actively advocating for these changes. And to me, that would be a major, major shift to really crowd in, potentially millions of Canadians.
Absolutely. Excellent. And Irene.
What else can I say? Well, I think, an obvious thing is to ensure, a policy change where we're ensuring that there continues to be non-repayable capital from government that will support deeper affordability in projects. We know that you can't really build a rent geared to income project without non-repayable capital. So I think that's important. I think the idea of government loan guarantees or loan loss pools that further will help organizations raise community bonds, invest in community housing funds and directly in affordable housing projects, and maybe unlocking private capital from financial institutions a little bit more. I think those are, and I love the tax credit idea as well. Like, I think unlocking individuals who can invest $5,000, $1,000, and are able to get a tax credit and support projects in their local community, I think is really, really powerful.
Absolutely. Well, and it aligns, right? I mean, you're invested in your community in so many different ways. And if you can invest and get that tax savings back, that I think improves that cycle even more.
Maybe one final thing I'll just add, and this is, and would love to see more social housing be considered charitable. And I know that's a slippery slope, like where do you end, and many not, but that would also help bring philanthropic capital more fully into the affordable housing development.
Yeah. Perfect.
Yeah.
Well, that is, I know we could stay on here. We've got 2 minutes left. So I will do the thank you and the quick wrap up. And then if we want to stay and chat, I don't see any more questions in the chat. If anyone does have any further questions, I think all of the contact information is going to be shared. We've got the webinar that will be posted both to the Catch Resource Center as well as to the Community Housing Transformations Center's resource inventory. I would like to thank you all for taking the time and as panelists on this and sharing your information. This was a great chat. I know we could sit here for a lot longer and talk more about these things. And thank you to Dina and all the people working behind the scenes to help host this. And everything went without any technical issues. So I'm pretty happy about that. If there's anything else anybody would like to throw in, that was great. Thank you very much.
Thank you so much, everybody.
Great facilitation.
Great. Thank you.
Thanks, everyone.